Hi, Nick Jevick with Trans Capital Pro, talking about the new equity pricing model that we put together. When you open this up, the first tab that you'll come to is the Instructions tab. Pretty self-explanatory. Talks about each of the tabs and what you'll need to do to make this model work for you. If we go to the second tab here, the Assumptions tab, you can see the interface is very streamlined, very clean. It doesn't require a lot of inputs. Total purchase price, you'll need to think about transaction expenses, how much debt financing you're going to have for your transaction, and then how much you're going to invest into this particular deal. And what you want to do is split that up between preferred and common. Put the least amount that you can in common, and then the balance you'll want to invest side by side with your investors. And then what it does, it calculates your financing gap. Based on your going-in EBITDA, which we'll look at here in a second. It gives you what your going-in transaction multiple is. We go to the second tab is the Forecasting tab. And so here's your base case. This is the year from which you're going to be, that you're basing your transaction on. And then here at the top you can see I've got two switches, a 0 and a 1. And so if there's a 0, your inputs for your forecasting are going to be based on the dollar amounts here, and if it's a 1, it's going to be based off of percentages. And so this just makes it a little bit easier for you to do a real quick and down and dirty forecasting. You may have a better and clearer view of what dollar amounts are for the first couple years of your business or the business that you're looking to acquire, and then thereafter you may want to just say, hey, you know, it's just going to grow at 5% or 7%, or we're going to stabilize gross margin at 30%. It just makes it that much easier. Down here at the bottom, you're going to also have to forecast debt and cash. Cash really, you know, if you want to be conservative, you can just leave that at 0. But if you have a model that does that, terrific. Go ahead and put that in. The other thing I'll tell you here is that to the extent you really want to just look at what returns are for years 4, 5, and 6, let's say, you know, you don't have to worry about forecasting what the debt balance is in the first couple years. You may want to do that just to see how your IRRs behave over the life of your deal, but really not necessary. We go to the last tab here. This is where all the information kind of comes together. You can see here up here at the top we've got 4 places for input. It really allows you to do a lot of scenario and sensitivity analysis. And so you know, if you want to say, well, listen, I want to pay an 8% dividend, you know, what does that do to my IRRs for the preferred? Or let's say I don't want to do a cash pay. I want to go ahead and pick my dividends. You can see here right away the annual dividends turns to 0, and the 8% dividend just gets accumulated onto the preferred. How much equity you need to give up. So you can see here in this example 36% in year 5. So let's look at 50%. What does that do? That gets me close to 30%. You know, maybe that's what clears the market. And so, you know, had you not known that, another 25% of equity that you would have given up and left on the table that you really didn't need to. Or let's say that your exit multiple, you know, you saw on the assumption page that for this transaction we're coming in at 4.7. Let's say you want to be conservative and just say, you know, my exit multiple is going to be the same as my entry multiple. So what does that do to my return? So you can see here we dropped a little bit to 28.4%. And so let's make that 52, let me see, 53, 55, so that gets me to 30%. You know, that seems fairly reasonable. So the last thing here is, you know, what does it mean to you? I think that's, you know, we're all doing this for, you know, the purpose of the exercise is to make money, as someone once told me. So you can see the IRRs to the common, you know, pretty big numbers, kind of exaggerated just because in this example we're only putting 30 grand into the common. Really, most of our investment is going into the preferred. And so down here I look at a blended return for the 250 that you're putting in, and you know, that's what really matters. And so you can see what the IRRs are on your total investment and what the total dollar returns are. You know, IRRs are great, but you know, you spend dollars, not percentages. So that's it. If you have any questions, go ahead and go to www.transcapitalpro.com. There's a contact us page. You can send me an email. You can give me a call. I'm available to answer any questions. And that's it. Thanks for watching. Take care.